Imagine this. You trying to insure your relative's vehicle or even your friend's stock under your own insurance policy. At first, it seems or may seem harmless, maybe even helpful, but in the short-term insurance space, it doesn't quite work that way. The principle is clear. You cannot claim for something you don't stand to lose from financially. And that's exactly where the concept of insurable interest comes in. I am Ryan from Remote Risk Management, and in this video, we'll cover why insurable interest underpins every insurance contract, how it connects with indemnity, the common gray areas that make it tricky to interpret, and lastly, how insurers may ask you to prove it at the claim stage. So by the end of this video, you'll be able to know exactly what insurable interest is, why it matters, and how you can prove it when it counts. But before we dive into the details, let's start with the basics and unpack what insurable interest really means. Insurable interest is a foundational principle of insurance law. It says that you must have a direct financial relationship with the item or the risk covered under your insurance policy. In other words, a claim is only valid if the loss would cause you a measurable financial harm. The absence of insurable interest doesn't just weaken your claim. It directly conflicts with one of the key principles of the short-term insurance, which is indemnity. Indemnity means that when you suffer a loss, you should be restored to the same financial position you were in before the loss, but never enriched. So without insurable interest, an insurance payout could actually put you in a better financial position than before the loss. And this can happen by paying for damages that never affected you financially in the first place, but someone else instead. Think about it. If you insured your relative's vehicle under your own insurance policy, you'd be profiting from their loss, and that's a clear violation of indemnity and that of the very purpose of the short-term insurance itself. Now that all sounds neat and logical in principle, but is it as clear in practice as it sounds though? Insurable interest might sound simple in principle, but in reality, it can be quite complex. Most people assume it just means that only the person who bought the item or the one whose name it's registered under can demonstrate insurable interest. And often that's not precisely the case, because at claim stage, insurers usually ask for proof of legal ownership. This could include purchase receipt, finance agreement, registration papers, or even sworn affidavit if deemed necessary. But let's look at a real example. Imagine you take out a vehicle finance loan to buy a car for your child, of legal age, of course. This child is listed as a regular driver. They use the car on a daily basis. And in practice, they are the real owner. Why? Because they take care of it, they rely on its mobility, and they would severely be disadvantaged if it was stolen or damaged. Here's where the gray areas comes in. The car isn't purchased or registered in your child's name. So even though they clearly carry a financial and practical risk, their ownership isn't automatically recognized under the traditional definition of insurable interest. And this often creates tension. They would suffer the actual loss, but without necessary documents to prove ownership, their ability to demonstrate insurable interest may be compromised. Now, here's where it gets more interesting. In a case like this, both you and your child have insurable interest. You because you bought the car and are responsible for the finance. Your child because it was purchased for them, they depend on it, and they would suffer the consequences of its non-existence. That as it may, only one of you can actually insure it. If both tried, it will create dual insurance and potentially exposes you to double recovery, something insurers simply do not even allow. For more on dual insurance, check out this link on the description. So, what does this show? The insurable interest isn't just about paperwork. It's about proving a genuine financial concern or connection to the insured item or risk, and showing how you would be disadvantaged if it was lost, damaged, or no longer existing. This brings us to the last important part of this discussion: how insurers may ask you to prove insurable interest at claim stage. Insurable interest is not only a guiding principle, it's also a legal requirement, and it has to exist at two key points, both at the inception of the policy and again at the claim stage. Without it, your cover could be considered invalid from the very beginning, or your claim could be rejected when it's tested. Earlier, we touched on the common ways insurers may ask you to prove insurable interest at the claim stage. This include proof of purchase such as a receipt or invoices, registrations or title document for vehicles or property, credit or finance agreement showing your responsibility for the repayment, and lease or contractual agreement if the asset isn't fully owned but is still under your care. But what if you do have insurable interest, yet you simply don't have documents like this? In this case, it's vital to disclose this upfront, either to your insurer or through your insurance broker at the time of inception or application, or as soon as you become aware of it, and always before any loss or claim occur. That transparency can make all the difference in protecting your cover and avoiding disputes later. And before we close, one last important point. This video was only made for sharing educational and general information purposes and does not constitute a recommendation or a financial advice. For personalized guidance on your specific risk, please consult a licensed insurance broker. Thank you for watching. Don't forget to subscribe and click the like button.